Don and Scott talked about two similar problems. One is that startups are sustaining losses most frequently in their early years, year after year after year, and they can't claim those losses for years. But the other one is related, is capital expenditure investment, that if they're larger than the small business allowance, they can't claim those as well for years and years and years. Does the tax code make any distinction, or are the rules essentially the same for when you're eventually able to deduct either losses on things other than capital expenses and capital expenses specifically?
Sure.
Does that make sense?
Yes. So my broad understanding of the way that it works is that for a given tax year, you first figure out how much of your capital expenditures from that year and prior years you're able to take a deduction for. And then you see whether you're in loss territory or not loss territory. If you're in loss territory, then you count up your net operating losses and hope that you have gains in future years to apply them to. Does that make sense?
Yes. Is there a difference in terms of the rate at which, I mean, is there any distinction made in terms of how you can offset future income in terms of capital expenses versus non-capital expense losses, is my question.
Not to my knowledge.
Okay, I thought it was the same, but I was just curious. Then my final question is, we didn't talk about the R&D tax credit. Startups often have a lot of research and development. I mean, it's the reason why they've started a business, that they've got a new product, a new service, or they're doing a lot of investment in terms of R&D. They can't avail themselves of the R&D tax credit because they don't have any income.
Yeah.
And Senator Coons, I believe, has an idea whereby startups would be allowed to deduct their R&D expenses against their payroll taxes as an alternative to deducting them against the income that they don't have. And I'm just curious if anybody on the panel has any ideas about that idea.
Yeah, I don't know about that idea, but I've been sensitive to it and skeptical of it. It seemed like a tax credit with good intentions, but it's going to be, again, larger companies that are aware of and able to claim it. So it seems like something that would be leveling the playing field is actually making it less level. I would think scrapping it in general, that seems like a pretty big ask.
This is always an issue with trying to run your industrial policy through the tax code. If it were a direct spending program, then of course there would be no relevance of your tax position to whether you could receive R&D credit. But because it's structured as a part of the tax code, there are all of these complicated interactions. In general, this is sort of a lesson to Congress that if they're interested in subsidizing parts of the economy, do it through appropriations, don't do it through the tax code.
I can say just for my clients, for the most part, the R&D credit is complicated. The likelihood that they're going to take advantage of it is more a function of whether they're talking to an accounting firm or another firm that does R&D work, and they'll come in and they'll say, well, I tell you what, and this can be even after the fact when the R&D has already been done. They'll come in after the fact and they'll say, well, we'll go back, we'll figure out whether or not you've got any R&D that's going to qualify, and then we're going to get a percentage of the credit. And essentially that's something that actually gets the interest, because otherwise, in terms of the mental bandwidth, there are a lot of entrepreneurs, they've got so many other things to worry about, that's just not on the list.
Okay, I'm going to violate usual think tank protocol where I'm supposed to have the answers and instead pose a question. Does anyone here know if that provision already passed? I have a sense that it passed a couple of years ago.
2015.
Yeah, so it was part of the 2015 tax deal. Yeah.
And it's in effect now. There's guidance out on it.
Wow.
Great, thanks.
For small business only. Eligible small businesses.
It's in that big stack of papers I got, I'm sure.
Well, maybe I should, one final question, we'll get to the hardest one of all. Trying to equalize the treatment between all these business forms. Been various talk of integration. In other cases, it's as you lower the corporate rate, you're trying to lower the pass-through rate to try to keep some relative balance between the two. Final question, I guess. What's the best way to equalize the treatment of of different business forms. Scott, you've written on this.
Sure. So as Scott mentioned, we sort of have these two parallel tax systems in the United States. There's the corporate tax system, which has a corporate level tax and a shareholder level tax, which is sometimes applied. And then you have the pass-through form, which is taxed at whatever brackets are part of the individual income tax. And it turns out that it's actually sort of hard to equalize the tax burden on both of these business forms. For instance, let's say that we went with a concept that's sometimes known as rate parity, where you set the corporate rate at the same rate as the maximum rate on pass-through businesses. Let's say both of those rates were 25%. Well, the tax rate on the entity levels would be the same, but corporations would still have this second layer of tax on some of their income, and therefore the pass-through business form would be tax advantaged. Or take another option. Let's say that you set your rates such that when you add up the corporate level rate and the shareholder level rate, well, those are equal to the top pass-through rate. Well, pass-through businesses could complain, and justly so, that wouldn't be equal either, because the shareholder level rate is not paid by all corporate shareholders. There are some tax-exempt shareholders, and it's also paid on a delayed basis. It's paid when the dividends are paid out or the capital gains are realized, and therefore, on sort of the initial earnings, the corporation would be getting a better deal. There's a whole family of proposals known as corporate integration proposals that are meant to solve this problem and that are meant to, using some roundabout method or another, turn the corporate income tax system into something that looks more like pass-through taxes. There are also some proposals that try and turn the pass-through tax system into something that looks more like corporations, but those are no good and should be disregarded. But one example is simply have the corporation allocate its income to its shareholders. That's known as shareholder allocation, and is probably the easiest conceptually way of doing corporate integration, except it's administratively complex. Another way to do it would be to turn the corporate income tax into a withholding tax, and then have taxable shareholders be able to claim a credit for corporate taxes paid. But that adds some policy design choices and complexities also. I do have a paper on this. It's called Corporate Integration, an Important Component of Tax Reform. If you're interested in reading up on a dry topic, I highly recommend it.
I'd have a shorter answer. I'd say 2 words: flat tax.
Flat tax.
I think having a progressive structure that's so complicated, it disadvantages risk taking, and that's essentially what entrepreneurship is. So I don't disagree with anything Scott said, but if you leave the room, you want to tax consumption, you want to try to have one rate, and then work out the details to make sure that the different entities are all paying that same rate.
So I would also put in plug for consumption taxation, although I'm more of a fan of an X-tax type structure or something that gives you more progressivity. I just want to highlight a point that Scott made about the types of investors who own corporate securities. Some of my colleagues at the Tax Policy Center took a crack at that, and their estimate was that only about 25% of investors, holders of corporate securities, U.S. corporate securities, are what you would think of as a canonical taxable U.S. investor. There are a lot of tax exempts out there. And one of the fundamental issues you have to confront as you think about reforming the system is, how do you feel about that? Right, and so the canonical example would be the Harvard endowment, but you could also pick your favorite nonprofit that has an endowment.
Like the Urban Institute.
Like the Urban Institute, Tax Foundation, Hoover Institution, whoever. Or I'm sorry, I don't mean to be, so the TSP, right, for those of you who are not just in the G fund, any of those things, own corporate securities, and you can view the corporate income tax as a way of, in essence, collecting some revenue on their behalf. You could have other views of it. But there's a question that, like if you just eliminated the corporate income tax entirely and everything was individual, how do you feel about the fact that it's only the 25% of taxable owners that you're going after, and you have these other folks out there. So you can have different views on it, and there are different ways to think about modeling it, but it is actually a really key underlying issue here as you think about this question.
I would just say, if you're talking about integration, corporate integration, you really should keep one rule in mind, and that is tax income once, not less than once, not more than once. If we can design a system to accomplish that, we've done it. And there really is no reason to have a double-layer tax system. At the end of the day, if we can manage to tax once, another thing that comes in play, not only is it tax-exempt foundations, but also foreign shareholders and so as a consequence, if you can tax income once, and that's where the credit proposal that I think is in your materials, the credit proposal, there are ways that you could do this that at the end of the day would not be anywhere close to as distortive as the double tax system is currently. There are ways that you can do this, and I realize there's a lot of academic back and forth and disagreement. On the other hand, if you take as your touchstone, tax everything once, not more than once, not less than once, you could get there. In fact, that would be a tremendous step toward tax reform. I think it'd be very constructive.
I think it's always important to end a panel with a bumper sticker slogan, and I think that was it. Tax income only once. And that's our lesson for today. Thank you all for joining us, and please thank the panelists. And we'll keep you posted on our future programs, and keep an eye on our website because we tend to post them there. Thank you very much.